The VIX is absolutely the most important thing to watch right now. We need to monitor the VIX. The reason why is because it has an inverse relationship to the market. As we can see right now, the VIX is holding above 17. If the VIX is bullish, that means the overall market is bearish. What we're seeing right now is the VIX is holding a major level of support at $17. If it can remain above 17, guys, this can bounce like it did a few days ago, and this will end up pulling the market down. That is currently what's going on with the overall market. VIX and volatility in general is leaning towards the bullish side. If we get a break below 17 on the VIX, that would indicate a lot of strength and a lot of bullishness in the overall market. But instead today, we had a big downward move today in the VIX. The VIX dropped to about 17.11, and then we ended up closing close to $18. So the VIX green for the day. Yesterday was a massive red day for the VIX. Today we bounced a bit green. What are the next steps? What's going to happen? This $17 level is the main factor we need to maintain and watch. So far, bulls are in control on the VIX. Keep that in mind. AMD just reported earnings. It's down almost $10 in the after hours. It's down 6% so far. So this is obviously not going to be very bullish for NVIDIA or the chips in general. SMCI also got smacked. So this is obviously going to be bearish. The fact that now AMD is trading below a very major level of support here at 167 level, currently in the after hours, not a bullish sign. So this could be a clear indication of a continued move to the downside, and this is a bear flag. Bear flags are extremely bearish patterns, so we need to see how much lower this can go. If AMD reclaims 168, then sure, this would just be a dip buying opportunity. But for now, based off of earnings, post-earnings, momentum should end up dropping a bit lower on AMD, and this could end up just really falling. If we return and bounce back around the 160 level, which is the previous highs and previous levels of support down here, this would be a magnificent buying opportunity on AMD. Because also, when you're looking at NVIDIA, right? NVIDIA and AMD both made a bit of a bear flag. NVIDIA is obviously not going to get hurt as badly from AMD's weakness, but this is also not the most bullish sign on NVIDIA. Remember, these past few weeks, AMD was outperforming NVIDIA in terms of percentage gain. Since July 22nd, AMD is up 18%, right? It had an 18% spike. NVIDIA had an 9.5% spike. So AMD has been rallying above NVIDIA. So the strength that AMD had permeated into NVIDIA. Now that AMD reported bad earnings, is NVIDIA's strength going to be able to maintain itself? That is a very clear, important question that we need to monitor. Also taking a look at SMCI. SMCI is down 16% in the after hours. Bad earnings. Reported very, very bad earnings. Clearly not going to be really, really good for tech. Not going to be great for the chips, clearly, right? So this is devastating, actually. So this is not a good sign for NVIDIA, AMD, clearly not for SMCI either. So keep that in mind. We've been showing tons of weakness on Amazon for sure, right? We've been holding below 215 on Amazon. As I said, if we remain below 215, Amazon has room to go to 208. And this 208 level is going to be an amazing buying opportunity. Massive level of support on Amazon. But when you look at things, right, that's only about a 3% drop. We could end up going to 202 to 203 level, which would be closer to a 5% drop. All in all of this, all of this on Amazon, down here, close to 202 to 205. Really, really awesome buying opportunity. I'm, in general, bullish on Amazon as we break down lower and lower, because Amazon is a really, really solid stock for the long term, especially longer term. For 6 to 12 months out, every single dip that we see in the market is an amazing buying opportunity. So please, yes, in the short term, we can remain holding 215 as a level of resistance. On Amazon, the market in general could be pulling back, etc., right? Every single pullback that we get is an amazing buying opportunity. 6 to 12 months out, book that. Listen to what I'm saying. So that's that for Amazon. Apple consolidating around the 202, 203 level, which is the 618% FIB that we've been monitoring. Clearly, very similar situation to Amazon. Both trading very far overextended to the downside in terms of the Bollinger Bands. Not the greatest setups, right? Could be better, right? These generally should be leading to some sort of a bounce. But the fact that Apple and Amazon are consolidating at support and giving time for the Bollinger Bands to even themselves out, right? So what I want to explain is just purely the Bollinger Bands, okay? So let me just talk about the levels real quick. 200 to 202, massive level of support for Apple. Below that, we're seeing 193, 194 very, very easily, okay? Keep that in mind. But what I want to show is the Bollinger Band, all right? So I'm going to use Amazon as an example. So as you can see here, looking at the Bollinger Band is so important because it shows overextension to the downside or overextension to the upside. When you're trading outside of the lower level of the Bollinger Band on a large trillion-dollar company, algorithms tend to buy way more aggressively while we're trading outside of the lower bands, okay? So the issue is that if we don't get a substantial enough bounce quickly, the Bollinger Band evens itself out. So the Bollinger Band is essentially an average. It takes the two standard deviations away from this orange line. What this is the 20 exponential moving average, okay? So this is a dynamic level. This is a dynamic exponential moving average. So this moves every single day, right? So this is just going to continue updating and updating and updating. So if we are outside of the lower level of the Bollinger Band like this, right? And say, for example, this candle, right? Wow, it was very, very far overextended. This red candle, very far overextended, right? In accordance to the distance away from the Bollinger Band. Very far overextended, right? But then what happened the next day? We gapped up, and now Amazon is trading within the Bollinger Band. So we're not overextended towards the downside anymore. So what this does is, because algorithms are not going to be buying as aggressively, we are not overextended to the downside anymore, which means that there is more room for us to fall again and again. And essentially, we can have a monstrous red candle tomorrow, and that would only be one day when we're trading outside of the bands. This becomes extremely overextended after 2 or 3 days in a row. Does that make sense? So right now, we've reclaimed back inside of the Bollinger Band. This is, if we don't get a massive enough buy program in the next 1 or 2 days, and we don't reclaim back above 215 to 216 on Amazon, just purely because we reclaimed the Bollinger Band, this can lead to a monstrous couple of days to the downside because we are not overextended to the downside anymore. If you look in the past, for example, here in April, right? We were overextended to the downside for 1, 2, 3 days in a row. The third day is when we had a massive rally to the upside, and then we bounced afterward, okay? So what I'm saying is, yes, we ended up, you could see prior to the massive downturn, in late March, we had a bit of a overextension to the downside. Flat We reclaimed the Bollinger Band, but because Amazon could not break back above 195, it led to a monstrous downward move. And this is a similar situation to what we're basically not as weak, right? I'm not saying this is going to end up happening. We're not going to see some massive drop. But what I'm showing you guys is the Bollinger Band in terms of overextensions to the downside. We were not overextended to the downside anymore from this candle, nor are we overextended to the downside anymore with this candle, which gives us a really, really important level that we need to break to the upside. If we don't break above these levels of resistance here, then Amazon can chop back up. If it doesn't break above, this is going to massively drop. And then it's going to get a much better buying opportunity after we are overextended to the downside. So that's currently what's going on with Apple. All right? Because we are just hanging around. You could see the Bollinger Band level is just moving lower. It's just falling here on Apple. So as the lower level of the Bollinger Band continues to fall lower, it is denoting that there is future weakness, consistent potential weakness that could occur in price on Apple. So just imagine, right? If the Bollinger Band was, so say for example over here, all right? Say for example right here, the Bollinger Band is rising, right? And then, wow, we just had a massive red candle outside. This is overextended to the downside. This becomes automatically a pretty decent buying opportunity, right? And wow, the next day we had another, the Bollinger Band moved up again, but the price dropped even lower. Buy everything with this, like take a mortgage out on your house. All right, this is these are amazing buying opportunities. So when the Bollinger Band is rising, but price is starting to fall outside of the lower bands, it becomes a great opportunity. Okay, but what we're seeing right now is it's inverse. The Bollinger Band is falling, and the price of Apple is hugging the lower bands. So this shows that there can still be more room to the downside, which is pretty scary if you're trying to go long. So what is essentially just happening here is you're just really hoping that these levels of support hold. Momentum is bearish. There isn't clear-cut buying pressure. We're not seeing a V-shaped reversal. This is tough, okay? This is not what you normally want to see if you're bullish at a level of support. They're not making this situation to go long easy on Apple or on Amazon. All right, so I hope you guys enjoyed this explanation of the Bollinger Band. If you guys did, please make sure to like, comment, subscribe. Let me know if there's anything else that I could do for you guys in the comments. Let's get started. Let's continue on with the rest of the video, all right? Netflix, just new lows, man. Netflix is just getting smacked. Absolutely just devastating. From the most recent highs, it's down 14%. Netflix is getting absolutely just smacked. Made a complete new low today. It broke below 1150. 1150 was a major level of resistance. It's at 1146 now. Very close to midnight, but yeah, wow, corny joke. Anyway, the next level of support on Netflix is going to be 1110, and we're going to have to see if that holds. That is only another 4% to the downside. Let's see. It could end up dropping another 4%. We dropped 2% today, but especially if the chips start taking a hit, which they did, money has to start flowing into other tech stocks, or things are just going to sell off. So we're just going to have to see what ends up happening. But Netflix, this is clearly not the most bullish situation. It's not even really setting up. A good buying opportunity on Netflix would be closer to 1130, in my opinion. Google once again came and tapped our target to the upside perfectly, failed, and dropped $5. So this is just, you can see that Google is just chopping around between this 193, 198 level almost perfectly. And this is generally what you don't want to see if you're bullish. You don't want to see multiple failures at a level of resistance, because trying to go long at this level of resistance becomes very difficult. And that's currently what's going on right now. Yes, this is clearly a bull flag, right? Clearly, this is bullish, right? Bullish situation. But you want to wait for a pullback closer to 190 to 188, in my opinion. Overall, right, we were bullish on Google down at 177. Now that it's failing at a level of resistance, this is not when you want to start entering longs, and this is not where you want to start trying to really become bullish, in my opinion. And 188, 190 is how much of a percentage drop? 2%, 2.5% drop. Pretty decent. So it's nothing crazy. And this 188, 190 level also coincides with this 618% fib. So there are a lot of reasons to be, bullish on these dips on Google in general. So to keep that in mind, I'm interested to see how Google and Microsoft will also be affected by the chips being smacked like this. So because AMD and SMCI both had very bad earnings, I'm interested to see how badly this is going to affect Google also not going to be able to break its resistance. So that's that. I got a short signal on the S&P 500 daily time frame indicator and on the NASDAQ daily time frame indicator. I'm an open book. I have nothing to lie about. I'm just showing you guys. Clearly, based off of my indicator, the momentum is bearish. It's shifting bearish. This is not the most bullish setup. Obviously, we had a massive, massive spike the other day, right? But what's going on is this is just a clear-cut, normal bear flag. This is a bear flag. We returned and retested the 618% fib and the 50% fib. And what I said was this was going to be a zone. Let's just recap what I said earlier, okay? When we fell down a few days ago, I said, guys, this is not the time to start leaning bearish. I would rather go short once the market bounces to a level of resistance. After it bounces to the level of resistance, that's when you want to enter shorts newly. We went short up here, okay? We went short over here. We're not chasing shorts down here. That's not the way to trade. What I said instead was, listen, guys, if you want to go short, you have to wait for a level of resistance. That level of resistance I mentioned was between this 50% and 618% fib. That's exactly what ended up happening. We came to that level, wick, massive red candle, failure, and now we're trading below the 38.2% fib on the S&P 500 ES futures. Same exact situation on the NASDAQ. Do you want to go short down here? Do you want to chase shorts? No, you do not want to chase shorts. You wait for a bounce back to a level of resistance. 618% fib, 50% fib, failure. To break above, boom. Follow through to the downside. You wait. Do not try to chase. You do not try to go short at support. You would rather wait and go short at resistance. That was what I was saying to occur if you wanted to try to go short. That's what I was saying. You needed to wait. Even if, so let me just explain something. Even if you wanted to, be bearish, right? Cool. But in terms of a trade, the safest trade would just be to, even if the market would continue falling, right? You wait for it to continue falling and take a tight stop loss and follow the momentum down. You don't just chase this here. You would, regardless, you would have a stop loss. You would still get stopped out. But instead of getting stopped out, right, the safer trade would be to wait for it to just bounce. That's exactly what ended up happening. We ended up going short. We ended up going short on the bounce. Okay, and that's what ended up happening. We went short on the bounce. And what I said that's what I would do. I shared it with my group. I shared it with the members in the group that I was going to go short. and I took the shorts, and a lot of people made a lot of money. It was a really, really solid opportunity, solid trade, and it worked out phenomenally. All right, so now we're going to see if we just continue falling lower. The issue is that, yes, the market in general is still very, very bullish, but we have to trade the momentum. I'm a simple guy. I'm an honest, simple guy. I made this indicator. It trades very, very well. It gives good indicator. It gives good signals. So this, coupled with the bounce to a level of resistance, coupled with this massive, massive red sell-off candle that we had after OPEX, after the majority of stocks reported earnings, guys, you had to be a bit bearish. All right, this whole big move that we got to the downside today, we were in it. We captured a big chunk of this move, and we're comfortable. We're comfortable, and it worked out really, really well. So thankfully, things are working out really well. Last but not least, we can take a look at the Russell. The Russell is the only piece of crap that is causing the S&P 500 to be not as red, because the Russell, the strength in the Russell permeates into the S&P 500. The NASDAQ also influences the S&P 500. But the Russell was one of the biggest reasons why I was bullish on the market a couple days ago, why I did not want to go short, because the Russell, guys, we could see the Bollinger Band again. The Russell was so far overextended to the downside, it had to bounce. It had to reclaim back inside. This, coupled with the VIX being so far outside of the upper bands, the VIX needed to fall back in. Both of those things are bullish for the overall market. Now, the Russell is, once again, still just similar situation. Still showing a lot more strength relative to the NASDAQ and the S&P 500. Not the best sign for bears, the fact that the Russell is doing this well. But it is a really, really good sign for Amazon. It's a great sign for Amazon that the Russell is doing this well. Tesla is chopping around. Tesla does not look spectacular, honestly. Let me just clean this up. Tesla, guys, does not look great. Clear cut, very bearish situation. This is a bear flag. If it, like, just immediately, it needs to break above 315. If it doesn't break above 315, we're going to see new lows, and around 288 to 290 is definitely going to be on the table on Tesla. If the rest of the market falls, it's not looking great. It's not looking great for Tesla. I would personally not really go long Tesla until we break and come to these levels of support, personally. The indicator has been short, and, no real reason to start becoming bullish until we come back to a major level of support, in my opinion, on Tesla. So I hope you guys enjoyed the video. Please make sure to like, comment, subscribe, do all that good stuff. And I will see you guys tomorrow. Have an amazing day. Thank you.